Good morning, trader. Comprehensive guide on the synthetic long put strategy. A step-by-step practical process with a script and analysis of three growth stocks. The main contents of the report are as follows. Synthetic long put basics, introduction and mechanics of the strategy, setup and execution, step-by-step guide for implementation, profit or loss, calculation formulas and examples for profitability, risk management, key risk and mitigation strategies, growth stocks analysis, three selected growth stocks with target price. A synthetic long put is an advanced option strategy designed for a bearish outlook, allowing traders to profit from a decline in the underlying assets price while limiting potential losses. This strategy is particularly relevant in the volatile cryptocurrency market, where sharp price movements can occur rapidly. Strategy mechanics. The strategy is constructed using two simultaneous traders. One is short underlying assets, e.g. sell short a cryptocurrency like Bitcoin. 2. Buy a call options on the same assets typical as the money, ATM, with the same expiration date. This combination replicates the payoff profile of a traditional long put options, but uses different instruments. The short position profits if the price falls, while the long call limits losses if the price rises unexpectedly. Payoff profile and break even. Maximum profit. Theoretically, if the asset price falls to zero, profit equals the short sale price minus the call premium paid. For volatile crypto assets, this can be sustainable. Maximum loss limited and occurs if the asset's price rises, calculated as the call strike price minus the short sale price plus the premium paid. Break even point, asset price at expiration equal the initial short sale price minus the call premium paid. Why use this strategy for crypto? Cryptocurrencies are known for high volatility and sharp declines. This strategy limits downside risk compared to a naked short position. Capital efficient, as buying the call reduced margin requirements for the short sale. Bypass direct put options limitation, as many crypto options markets are less liquidity. Step-by-step practical implementation. Step 1. Market analysis and selection. Identify a bearish candidate. Use technical analysis, e.g. break-even point levels, bearish RSI divergence, and fundamental analysis, negative news, regulatory concerns, to select a cryptocurrency expected to decline. Choose an assets with liquid options, Bitcoin or Ethereum. Options on regulated US platform like CME or crypto native exchanges where available or preferable. Step 2. Position sizing and entry. Determine the size based on your risk capital. For example, if shorting 1 BTC, you must buy one call contract assuming one contract equal 1 BTC. Execute the trades simultaneously. 1. Short sell the crypto assets at the current market price. 2. Buy an ATM call options with a strike price near the current assets price and an expiration date matching your bearish time frame, e.g. 30 to 60 days. Step 3. Monitoring and adjustment. Set stop losses. Monitor and assess price. If it rises above your calculated maximum loss threshold, consider closing the position early. Roll the option. If the price decline is slower than expected, you may roll the call option to a further expiration for all additional costs to maintain protection. Close the position to realize profits. Buy back the shorted assets at the lower price and sell the call option, which will have lost value. Step 4. Exit at expiration. If assets price is below strike price, the call expires worthless. Buy back the shorted assets at the lower market price to realize profit. If asset price is above strike price, exercise the call to buy the assets at the strike price, covering your short position. Your loss is limited to the difference between strike and short sale price plus premium practical execution. Visual screen split into two sections. Left shows a trading platform with Bitcoin short. Right shows a step-by-step checklist. Welcome to the practical walkthrough of executing a synthetic long put on Bitcoin. We are using a simulated environmental for education purposes. Step 1. Analysis. First, we analyze Bitcoin's chart. Notice it is breaking below the $60,000 support level with increasing volume. A bearish signal. We decide to implement a synthetic long put, expecting a decline to $55,000 over the next month. Step 2. Execution. On the trading platform, we simultaneously executed two trades. One is we short sell a 1 Bitcoin at the current market price, that is $59,850. Second, we buy one ATM call options with a $60,000 strike price expiring in 45 days, paying a premium of $3,200. Our net cash flow is initially positive because we receive more from the short sale than we pay for the call option. Step 3. Monitoring. We set an alert at $62,500. Our calculated maximum loss point. If Bitcoin rallies above this, we will consider closing early to minimize the losses. As Bitcoin drops to $56,000, our short position gains value and the call option losses value, exactly what we want. Step 4. Exit. At expiration, Bitcoin is at $55,200. We buy back 1 Bitcoin to cover our short position, netting a profit of $4,650 On the short side, our call option expires worthless. Our net profit is $4,650 minus the 300 to $3,200 call premium, which equals $1,450. If Bitcoin had rallied, instead our loss would have been capped at $2,350. Remember, always paper trade first and ensure you understand margin requirements for short selling. Strategy components: 1. Short asset position downward, sloping line showing profit as price decreases. 2. Long call position, hockey stick line starting below zero, turning up after strike price. 3. Combined synthetic put, mirror image of long put, limited loss on upside, increasing profit on downside. Critical risk consideration for synthetic long put: short selling risk. In crypto markets, short selling can be riskier than in traditional markets due to potential for extreme volatility and exchange changing rules during market stress. Liquidity concerns: crypto options market may lack liquidity, causing wide bid-ask spreads that impact entry and exit costs. Regularity uncertainly evolving: cryptocurrency regulation in the USA could impact strategy viability, including tax treatment and platform availability. Margin requirement: short position require maintaining margin. If the asset's price rises significantly, you may face margin calls, forcing early liquidation at a loss. Counterparty risk: trading on some crypto platform involves trusting the exchange as counterparty, which carries risk of platform failure or fraud. Important disclaimer: this guide is for educational purpose only. Options and cryptocurrency trading involve substantial risk of loss and are not suitable for all investors. Post performance is not indicative of future results. Always consult with a qualified financial advisor and tax professional before implementing any trading strategy, and ensure you fully understand the risk involved. I hope this comprehensive guide provides you with valuable insights into implementing the synthetic long put strategy for cryptocurrency. Trading. Would you like me to elaborate on any specific aspects such as tax implementation or platform comparison for US traders? If you want, comment it. I will provide you. Another 3 growth stock with the target prices. 3 main growth equity shares. Based on Morningstar's analysis of companies with wide economic moats, predictable cash flows, and smart capital allocation, here are 3 growth stocks with solid long-term outlooks. First, company name and symbol. Second, current business position. Third, growth drivers. Fourth, target price and rationale. First company is Tyler Technology, TYL, dominant leader in public sector software niche market. High switching cost creates a wide economic moat. Market trends, accelerating demands for SaaS and modernization of legacy government ERP systems, undervalued growth, expecting revenues CAGR of 90% over next 5 years. Stock is considered significantly undervalued heading into 2026. Second company is CoStar Group, CHGP, property database for commercial real assets, 35 plus years of development, intangible assets and network effects, foundation of wide moat, data dominance, data base is bedrock for all products, creating high barriers to entry. Price target 81 per share dollar. Expected revenue CAGR of 12.5% annual over the next decade. Third one is SAP, SAP, world's largest provider of enterprise application software and ERP. Market leader, high switching cost, wide economic moat, cloud transition, shift to cloud-based solution, driver recurring revenue significantly undervalued, expected low to mid-teen revenue growth near term, fading to high single digit growth long term. How these companies achieve growth? Tyler Technologies growth comes from the essential digitization of government services, a long-term trend with limited competition due to high switching cost. Second company is CoStar Group. Growth is driven by the increasing value of comprehensive property data in commercial real estate, creating a virtuous cycle where more data attracts more results. Third company is SAP, maintains growth through its dominant position in enterprise software, leveraging exciting customers' relationships to transition them to higher margin cloud platforms. These companies represent quality growth. They grow not just revenue but do some with sustainable competitive advantage, right? Modes. They protect their market position. Remember, this is advanced trading territory, especially when they combining crypto volatility with option strategies, the most important step before risking real position. Real competition capital is to practice on in a simulated environment. Paper trading first and ensure you fully understanding the mechanics and risk. Important paper trading, dear traders. Happy trading and always prioritize managing your risk. Please like, share, subscribe and comment. Another 2 minutes video, under 2 minutes video is there, that is the hot touchable video. You can find out what is what.
The synthetic long put strategy is a versatile approach in options trading, particularly useful within the cryptocurrency market in the USA. This method allows traders to benefit from expected declines in cryptocurrency prices without directly purchasing a put option. By combining a short position in the underlying asset with a long call option, the strategy mimics the payoff of a traditional long put. The step-by-step process involves shorting the cryptocurrency, buying a call option with a strike price near the current market value, and closely monitoring both positions. This approach provides a structured way to achieve minimum profit while managing risk in volatile markets. Apple, Microsoft, and Alphabet stand out as leading growth stocks in today's equity market. Apple is currently trading at $273.67, backed by a market capitalization of approximately $3 trillion, with continued innovation in consumer electronics and services driving its strong revenue growth. Microsoft, trading at $485.92 and valued at around $3.85 trillion, benefits from significant expansion in cloud computing and software services. Alphabet, with a stock price of $307.16 and a market cap near $2.94 trillion, maintains its leadership in online advertising while diversifying into various technology sectors. Analysts have set target prices of $300 for Apple, $520 for Microsoft, and $330 for Alphabet, reflecting confidence in their sustained growth and future prospects.
And another, this is mine, only creators, Google Ads, subscribe plus grow your channel. Your channel will grow, you will subscribe Google Ads. This is second one is mine. Please like, share, subscribe and comment. Google Ads not the affiliated program. Thank you friends. We will meet next day episode, next day video.